we've got Dipula Income Fund listing on the JSE this morning, and the success of the capital raising by way of private placement earlier this year certainly reflects the strong support that you've managed to harness from the market. What's the investment case you're putting on the table right now?
Sorry, I couldn't hear that.
Just run us through the investment case that Dipula Income Fund holds at this stage.
Well, yes, the Dipula Income Fund brings to market an A and B unit structure, which was alluded to, I think, earlier in the interview that you're currently having. Basically what we bring to market is a diversified portfolio which stretches over all 9 provinces. We're involved in all 3 sectors: retail, offices and industrial. And all of that is also spread throughout the country. We've got a Gauteng bias in terms of where the bulk of our revenue is coming from. And from a tenant mix perspective, the fund has some 70% exposure to A and B tenants. And A and B tenants are usually termed your national tenants, as well as your large listed companies and medium-sized listed companies, as well as professional firms. We have very little exposure to where most of the pressure points are in the economy at the moment in terms of property. So our office exposure is the least in the portfolio. And basically our limited office exposure is also to quality tenants such as government and large national tenants.
At the moment, though, that retail exposure is, bulk of your portfolio right now, and there's a focus specifically on the lower end consumer, and one would assume that there's some risk inherent there in that, the vibrancy of this market in this instance is very much dependent on the health of the South African consumer.
Yes, I would agree that as a general rule, you should be worried about retail, but we share a slightly different view at the moment in terms of how we exposed. Our property portfolio is mainly exposed to lower income groups or lower income groups. And we foresee the market being a lot more active in those lower income groups for various reasons. One of the reasons is obviously we do believe that the government is going to come through with its social spend checkbook. We also believe that government will continue to be the catalyst for jobs in the economy at the moment, and our portfolio will, as a result, benefit from that sort of spend.
Your average escalation rate, run us through that, because just so we can get a sense of the pricing power you actually hold in this market.
Our average escalations are 8.4%. That's weighted average. Obviously, we achieve much higher and maybe lower than that figure for any given tenants. But on average, across the portfolio, 8.4%, which is well above inflation.
Isaac, what is your forecasted dividend yield 1 year out?
Our A units are forecasted to yield 9.25. in the first year, and our B units are forecasted to yield 10.73, which is by far the highest yield in the sector.
For an investor looking to delve in, run us through that distinction being made by your A-linked units and your B-linked units, and the kind of risk-reward scenario they'd be venturing into in those instances.
Well, the A unit has bond-like characteristics. In the first year, obviously, it would yield the 9.25. Thereafter, it yields 5% for the first 5 years, and it then yields the lower 5% or CPI after 5 years. So you almost have certainty of growth of income for the first 5 years until 2017 for the A unit. And the B unit is basically the equity unit in a whole formula. What excites us, personally, I would put most of our money in the B units, because what the B units have the potential of doing at 10.73 first year yield, there should be capital appreciation on that unit to start off with.
Yeah.
But most importantly, if our income in the first year grew by 7 or 8%, the B unit would grow at 12%. And we've seen what the Fortress B units have done. They've completely outshot the A units in terms of capital growth.
Well, looking at that capital growth and where you're chasing it moving forward, I mean, Dipula is set to acquire some 700 million rand in investment properties from 2 vendors as part of this listing. And of course, we've known that the private placement and the listing will enable future acquisitive growth moving forward. What's the market looking like at the moment in terms of opportunities for yield enhancing acquisitions?
I think there's absolutely room. We are currently looking at quite a sizable chunk of opportunities, and I think if you look at where we're funding on the senior debt side, I mean, you know, we've locked in very favorable rates. I mean, we've locked in about an average of 8.5% of average long-term debt. I'm talking here 4 or 5 year out debt. So we've got a fair amount of scope there to expand our portfolio, and certainly our goal in the next 18 to 24 months is to try and do acquisitions of at least 1.5 billion to about 2 billion. I know that's ambitious, but that's the sort of pipeline we're looking at the moment, and hopefully we can bet it down.